All right, thanks for joining us, everyone. We are going to kick off this segment of retail with Andrew Ziffer and myself here, and it's definitely been a change this quarter from last quarter.
We've had a 3-month turnaround in how we do business, so a testament to how we change the business.
If we know what we're doing.
Well, I'm not going to say that. I have confidence we're doing a good job and we're doing what we should be doing, but we have to pivot now. We're pivoting.
Certainly, yeah.
So.
It's definitely been. It's been very different between, even 12 months ago to now, with the main thing being the interest rate change, but the type of deals we're able to find and execute on from 3 months until now has definitely changed. But we want to cover a little bit of what we're seeing in the market and then kind of go into our perspective of how we find value and what opportunities we're looking for. So first, the easiest one is interest rates.
Interest rates. Oh my God, interest rates. So last year we would get debt into 3% just over and over again. We were getting debt 3.5, 3.75, and it was just so easy.
Yes.
And prices what they were, and honestly, prices are probably similar to what they were last year. But debt difference between 3.5 and 6.5, that's quite a difference.
It's very different.
And so we can't necessarily model deals. Like last year, we were modeling deals based on a 5-year hold cycle and a cash flow deal, and now it's different.
Right. So, those same deals are no longer. Well, one, even with interest rates higher, bank lending, the number of players in the lending space has declined.
Yeah, I think you told me you had one of your banker friends just shut down.
Yeah, they're kind of just on a pause right now. So they're like, okay, we're going to wait and see how things go.
So all these mortgage brokers are just hanging out of their house, just playing on the internet. Is that what they're doing?
I think they got I think there's definite challenges on how is the debt being placed out there. And from their standpoint too, if you're pushing a loan out and 30 days from now the Fed's going to raise interest rates and you're going to be behind on it, it's like, maybe we should just wait.
Right, and they're also betting on they're betting on that interest rates will eventually go down too, because they have to model a loan over the term of the loan, and they don't know where interest rates are. They still have to sort of make their intelligent prediction.
They got to make a guess on it. But
yeah.
Pricing wise though, sellers, most people interest rates have been so low for so long that most sellers don't necessarily need to sell something. So they're kind of holding on to values where we're not seeing those prices really adjust too much.
Well, and especially for our deals, our deals, we're doing 65%, maybe 70% loan to value. And so we have a lot of room for error for values to go up and down. And so we're not in any, we are doing exactly what we should be doing. We're living to plan. We're not necessarily going to be we're not going to be a casualty of interest rates, because I think the first debt we have due is 2024.
All of our current debt that we have, we have 2 loans that come up in 2024.
Right.
And then mostly like 2026 and 27. So we can think about and work through interest rates, but we've got a long time before they definitively
2024, 2025 is like a lifetime for a real estate purchase.
It's quite a while. But that's also our going into strategy with this was finding cash flow deals. So we have good spreads on all of our assets as we hold those fixed rates. We'll be in good shape cash flow wise. It just comes further down the road then.
And don't forget about the most important part, that we are buying the deals right. We are buying deals that are under appraisal, or we're buying deals correctly. We're not buying them above value. We're buying them below value. And then we're also operating them well. And so we're going to make money because we bought it correctly. We're operating it well. And then at the exit will be a byproduct of how we purchased it and how we operated it.
Yeah, definitely. So another thing, when we think about people that don't have to sell, in our situation, we don't have to sell deals. Also, other sellers don't have to sell them. So we haven't really seen any price adjustments yet.
Didn't you say to me once that you never, ever wanted to sell a deal?
Well, if you could hold it forever, I think that would be fantastic. So hopefully you don't have to sell.
Time for real estate is where things happen. And so
time has historically been on the side of real estate.
Yes. In fact, every single real estate purchase I made, no matter what decision was made, time is always...
Time benefited?
Time benefited, Time benefited the value of the real estate.
But I think eventually that starts to change, especially people having to sell or not wanting to sell, as there's, we've bought a couple deals out of estate transitions where it's like, look, this, estate issue happens and now we just want to exit this deal. We just want to sell it, and that's where we come in as a buyer for that. But that's a unique situation that we have to find in the market. It's just not a readily available market transaction.
Right.
And we've kind of really haven't been in that space anyways.
Yeah, but we've been on the other side of it, like our Whiskey Road Panera deal.
Oh, we love to sell that way.
That was an estate.
Yeah.
We bought it from an estate. So we were on the receiving end of that actual
Yeah. Oh,
problem.
yeah, that's how we like to buy it. When we sell it, we're normally trying to sell
Yeah.
open market as much as we can.
Yeah.
So
Yeah.
other things interesting happening in our space is mostly the QSR. Like we're mostly in quick service restaurant stuff, but then we're also in like the dollar store stuff. And if you think about dollar stores in general right now in the market, there's been a push towards finding value, especially as we see inflation hitting people's pocketbook harder. They're trying to find like, where can I get the best value, or where can I spend as little as possible? And that's normally, dollar stores aren't necessarily the best value, but they are normally spend as little as possible to get something.
Right, and I look at dollar stores as, I'd call them like a dollar store, like a C-grade apartment complex. A C-grade apartment complex is heavy management, but with that heavy management comes better returns. Because I think like the cap rate spread between a C-grade, a B-grade, and an A-grade apartment, I always want to be in the C-grade because, it's
A little more work, but more
work.
return.
Yeah,
And,
exactly.
and dollar stores, essentially the same thing. It's not a Costco where you have this
Right.
enormous box and huge revenues, but you have smaller revenues per footprint, but your profit margins are
Right,
higher.
and don't forget the demographic too. The demographic of who goes into a dollar store and who goes into a Costco is also very different too. So the dollar store probably has a bigger population or a bigger net to cast than maybe a Costco. Costco's in Dunwoody and Alpharetta, but is there a Costco in,
I definitely go to a dollar store more than I go to Costco.
Oh, even you do? Okay, well, you just like dollar
So
stores.
I'm on the other side.
I think you might be an exception though.
But we look at the QSR space too, and a big thing happening there is just price increases in general. So month over month restaurant pricing, like if you're just going to go to an Applebee's, you're going to go to a Zaxby's, you're going to go to one of these types of restaurants, month over month costs are up about 16% year over year. So that's a big swing on the cost of going to dinner or going to eat, and that's going to push people to cheaper dining out options.
Yeah, well, I've heard statistics right now that like 15-year-olds are being paid $15 an hour, $12 or $15 an hour
To get them to
work.
Yeah.
So good for them, but
I did not earn $15 an hour
no,
when I
I
was
think
a teenager.
I was maybe $4 an hour my first job out of high school, but that could be telling more about my age than anything else.
Another thing we're kind of seeing as we get a lot of data reports on kind of what's happening, especially at our restaurants that we own and in the market. And we're starting to see a leveling of drive-through. I mean, obviously drive-through kind of peaked at COVID, right? It was the only way you could even really get anything, and that's kind of leveled out now.
I wouldn't call that a peak. I would call that the complete, like the Mount
The
Everest.
complete summit.
Yeah, the summit.
That's as high as it could go right there.
Yes.
And now it's more level now. So
Yeah. Well, don't forget, we had one restaurant, our DQ, that was just...
it was just drive-through only.
drive-through only because they made 70% of their revenue with less than half of their staff. And so why would you ever want to...
Why would you open the other?
Why would you open the dining room and have to pay for somebody to take out the trash and manage the register when you can make 70% of your revenue with just a handful
Just
of
drive-through.
people?
Yeah.
Yeah.
So another part is less mobile orders, which kind of falls right along with what we're talking about with COVID. As that comes down to a more normal rate, you've got more people just actually going into the restaurant and ordering.
I personally am relieved that I can sit in a dining room now. So
Yeah, me too.
no more dishes, especially with kids.
Yeah. So, our perspective of how we kind of see Greenleaf operating in this environment and where we're, one, creating value or really executing on that value. One point we did do is we're selling 2 of our Dollar Generals right now that we're working through. And those were deals that we purchased with short-term leases right in our business plan and then signed a 10-year extension with them.
One of them we moved it to a 10-year lease, and one of them we moved to a 7-year lease. So both of them we got the lease extension, and literally right after the lease extension, that's going to be the most it's going to ever be worth during our ownership. And so we put it up for market. And just to even throw in a little bit of a additional sort of perspective on this is Dollar General stores are fairly cheap. They're less than $2 million. And so Dollar Generals appeal to a lot of cash buyers. And cash buyers don't care about debt.
Right.
So it's a little bit of an easier product to sell. So our Dollar Generals, a $1.5 million Dollar General is a lot more marketable than, say, like a $6 million office complex.
Yeah, there's a lot larger purchasing pool
Yes.
of buyers that are interested in a $1.5 million publicly traded company backed asset.
Right.
But that is to say, like the deal volume that we're seeing, our opportunities to go find those is becoming less. We're not seeing as many that are, one, interested in selling because they're like, okay, we'll just keep this. So we're not finding as many. And the deals we do find, we have to go find a specific reason that we can create value with a specific tenant.
Right, most of the Dollar Generals on the market right now, are the new Dollar Generals are coming out at like 5.5 caps, which, when you have debt at 6.5 and buying a 5.5 cap deal, you're just upside down.
We've talked, Dollar Generals open up 1,000 stores.
Yeah.
So obviously that means they're putting out a huge number of stores that are for sale,
Right.
that are brand new builds. They have a brand new long-term lease,
Right.
but they're expensive.
So
On a cap rate
somebody with
basis.
$1.5 million or $2 million just laying in a bank account and getting 2%, they just go buy a Dollar General and they get 5.5%. So it's a better deal for them, and they don't get any debt. So it's an easy deal for them, and they don't care about lending.
Yeah, they're just buying it for cash. That's kind of how we're looking to sell the two we are selling.
Right, and so the target buyer for our two that we're selling will be very, very low debt, if any, and it'll be somebody, maybe in a 1031, or just an entrepreneurial investor versus like a big company. Like a Greenleaf is not going to buy our Dollar Generals that we're selling. It's going to be more of a individual, a doctor, a lawyer, just with some cash to place.
Yeah. So from our standpoint of what we can buy in the market, we're not buying anything that's more like betting on the market to just go up, because that's not what we're seeing right now. So it has to be this strategic opportunity to buy something. That's kind of exactly what you did with the IHOP.
That's the new
down in
apartment
Houston.
model. You buy and you just plan on appreciation.
Oh, you just buy and hope to sell it for more in the future?
Yeah, well
With
now,
Yeah.
And that's why we have a tough time
we
buying
haven't
apartments right now.
bought apartments in a long time now because of that. But
Yeah.
IHOP, what you executed in Houston, is a prime example of where we can find value in retail opportunities. And that's kind of really kind of whatever's going on in the market space. If we can find these value creation opportunities with a specific tenant, that's where we can execute a purchase.
Right, so our business model is we're pivoting to being less dependent on interest rates and more dependent on something we're fixing. So we're fixing a piece of paper like a lease, we're fixing a problem like sales. In fact, we're working on another deal, which we'll talk about soon once we get under contract, where we're going to actually, we have an operator who's not doing so well. And so we want to go in there, take over operations with a better operator and improve sales and get it operating and then make it a viable business. And actually this would be a perfect cash flow deal too, because we would actually be involved in the operations of it. So we would profit from both the real estate and from the operations doing better.
Yeah, and operationally, things like the Family Dollar that we purchased, we got a discount on that purchase because there was a good amount of operational work and capital improvements that needed to be done.
Right.
And we said, hey, we can go in and we can buy this and we can execute on the operational needs, and we got a discount beyond just the pure spend that had to be done.
Right, good example, because the Family Dollar, we had to go in there and fix a parking lot, we had to go paint a building, we had to go fix a couple of roof issues.
Yeah.
And a lot of times when you own a building for 10 years, you just don't want to do that. You just don't want to spend the money.
And a new buyer doesn't want to come in and have to go do all this work.
It's not like the bank's going to give you the money, or you're going to take the money out of your pocket, and all of your margin for the year basically goes to that repair, and so you make nothing. So why do it rather than just give it to somebody else, make it their problem?
So that deal, we got a discount beyond what the capital improvement spend was needed. So we saved money on that. We got a better deal because of that, because of the operational component that we knew we could do.
Yeah, that's our Family Dollar in Decatur, which has turned out to be a great purchase, and people come to me and say, hey, that was a really good Family Dollar.
Yes. Those are the opportunities that we have to find now in the market. And obviously there's always less deals that have problems than deals that don't have problems.
Right.
Well, for the most part. Right now, that's what we're seeing.
Remember, we're always still looking at 1,000 deals, or, we make offers on 10 out of the 1,000, and then, we get hopefully a couple of those accepted.
Hopefully a couple, will come to the table. So we still very much expect to be able to find those opportunities over the next year. I mean, it's not going to be at the same volume as we were able to find them in the past, we think, but expanding our footprint a little bit here. We're looking at Florida and we're looking at Texas as well, and that opens up a little bit of that. The IHOP was in Texas, so if we weren't looking at Texas, we would not have seen that
Number 2 deal in Texas in just a few months.
Yeah, just a couple months, and we got 2 of them down there. So both good opportunities where, we think we're able to create value within the market. So, cool. All right, I think that's pretty much it. The retail market, we've had a bunch of good purchases. We're still finding opportunities to find value.
We had a very busy Q1 and Q2, and I think the statistic we have internally is Q1 and Q2 was our busiest year ever. If we just take Q1 and Q2, literally we've done more in that 6 months than we've done in every year prior.
And for the most part, we were able to use that period to really just lock as much debt as we could as we could do. We completed a bunch of refinances across the board.
Yeah.
You know, we talk about retail segment, most of our loans going out to 2026, 2027. So we've got a long runway of very cheap debt that we're going to be able to generate cash flow returns on for years to come.
So when's the break? Because I'm still really busy.
Yes. I'm pretty sure we'll keep finding things to
so?
things to do and finding opportunities to add value
Okay.
to real estate
Let me
opportunities.
know when I can take a break because I'm still very busy.
So, cool. All right. Well, that's it for this segment, and we're going to be doing our live Q&A next Thursday as well. So you can tune in for that, where we can kind of go through any questions you may have. We're going to touch on all of our asset classes in that one as well. So thanks for watching.
Thanks.